Hello and welcome to this video edition of the Market Share. I'm Paul Gifford, Chief Investment Officer of First Source Wealth Advisory Services. And today we have with us Rob Romano, who is our Director of Research. Now Rob, we know that the stock market has had an incredible recovery. In fact, the S&P 500 is up over 100% from the early days of the pandemic. And part of the reason for that surge has been the reopening of the economy and corporate earnings. And what can you tell us about what we just have been seeing here in the second quarter as far as earnings?
Well, second quarter earnings are coming in well ahead of expectations, and that's not the surprise. What is a record 89% of companies have exceeded those earnings estimates by analysts by an average of about 17%, and you can see that in this chart here. When we look at the revenue line, 85% of companies are beating on the top line by about 4%. Heading into the quarter, analysts were expecting earnings to be up 52% year over year. Again, that's versus a low bar the prior year, but earnings actually came in up 88%. That's one of the largest earnings growths we've seen for any quarter, and it really just shows the profitability of corporate America.
Yeah, those are crazy numbers. I mean, you and I have been doing this for 30 years, and I don't remember a whole lot of times you've seen earnings up that much. So why is it that the expectations were so under what we are seeing reported by the corporations?
Well, there's a few factors at play. One is simply the reopening of the economy led to higher sales volumes and better revenue growth. Secondly, companies managed their businesses for the pandemic and not a recession. And when I say that, I mean they aggressively cut costs across the board, and that led to higher efficiency and higher margins. Lastly, we saw companies accelerate their investments in digital transformation. One example here is Chipotle. They receive 50% of their orders now over the internet, and that has led to higher productivity for them. So collectively, through these measures, S&P 500 operating margins are at record levels. And again, you can see that in this chart here.
Well, we know record profit margins don't always stay at record profit margins, and we're already hearing some things from executives of the companies. So what can you tell us that they're saying and concerns that they see ahead in the next year or so?
Sure. As we listen to corporate conference calls and read the earnings reports and research reports, we're hearing companies talk about higher input costs, higher transportation, logistic costs, raw material costs, and of course, higher labor costs. So there seems to be a difference of opinion between what the Fed believes inflation is and what corporate America does. Now, the Fed believes inflation is shorter term in nature. They've been using the word transitory. Whereas when you listen to the executives who run these companies, they've been saying that these costs are going to be longer term in nature and will be more sticky, especially when it comes to labor costs. So because of this, we believe that rate of earnings growth is going to slow. And then when you add into that the Federal Reserve reducing accommodation, and then the stimulus from the federal government and some of those programs ending, we do believe that rate of earnings growth will slow going forward.
Well, obviously our investors have enjoyed the really good stock markets we all have, but we know that there could be some challenges ahead, and we will continue to watch that. So Rob, as usual, I really appreciate your insights into what's happening with corporate earnings. To those watching today, thank you for taking your time, and to the clients that we have, we really do appreciate the opportunity to work with you and your families, and have a great day.